So week 6, um, another week we're going to be talking about loans, personal loans, different loans. One thing, if you didn't, I don't know, I'm kind of curious what people thought about that video. Not so much the one that I asked you to comment on, but also the Raul Paul. He's an interesting guy, and I do like a lot of these guys' approaches to personal finance, not necessarily the traditional ones. I was reading an article this week and it was talking about how Dave Ramsey, who's like this old school personal finance guy, and he's kind of out of favor with the younger generation because a lot of the stuff he says is maybe not realistic. I don't agree with a lot of things he says. He certainly wouldn't approve of my approach to investing or certainly my approach to mainly investing, but also loans. I mean, he's one of these guys that all debts need to be paid off, and you start with the smallest debt. I'm so distracted by that because you pay off the debt that has the highest interest rate. Debts with lower interest rates, maybe on real estate that have appreciating assets. One strategy is to not necessarily pay those off, as you're essentially renting money for a very low price. But anyway, that's definitely this is where opinions come in. But Raul Paul, the guy who I referenced in that thing, he's definitely in my camp. One of these guys who's more focused on not frugality. I mean, that part of personal finance is necessary. I mean, you need to get out from under any kind of credit card debt to be able to invest. But once you've done that, what you do with your money, or perhaps how to gain more money, that's more motivating, and it's more on the positive side. So anyway, enough about that, but we'll see if there's any more interesting things that come up. But again, and oh my God, for my demographic, being not quite a boomer and to be, into crypto and speculative stuff pretty heavy is that's not, my peer group is not doing that. So anyway, maybe I've got more in common with you all, but we'll see. I don't mean like I'm some try-hard, but I'm just saying that I think you all might understand more about the realities of the current financial situation, and unfortunately sometimes that leads to some frustration because some of those realities are not good, especially if you can't get away from the high price debt so that you can invest. But anyway, okay, background on personal loans. Yep, finance large purchase, financial institutions, so banks, savings institutions, credit unions, these are all the same kind of things, except finance companies. Finance companies are that's a nice name, but really what they generally are is a lender of last resort. If you can get money from a normal bank or credit union or savings institution, again, we've talked about how these have kind of blended together, but the one of these does not belong in this group, and that's kind of the finance companies, because they charge pretty high rates. Depends on what side you're on. I would consider them predatory, but if you need the loan, you're going to do what you got to do. It's good to have somebody out there who will loan the money, short of a loan shark, but you're pretty close. Family, friends, and members, yeah, you can do that, but again, you don't want to abuse relationships. Peer-to-peer lending, they're kind of big on this. The theory of peer-to-peer lending, this is almost like not a Napster or Pirate Bay kind of thing, but in some ways it is. Anyway, this is some high-tech companies have come up with some solutions that are outside of the normal banking sphere. And what happens is they try and get people with some wealth who are interested in investing, and they try to match them up with people on the other side who need the money. And normally, small businesses are not a great risk, especially like Silicon Valley startups. 9 out of 10 fail. So, that's probably not where you want to be investing exclusively. But, that 1 out of the 10 that does succeed, man, it's going to go exponential. So what these guys try to do is, let's say you give them some reasonable amount of money, $2,000 or $5,000 or something like that, and they will put this out in all these sort of micro loans. And so they'll because computing power is cheap, and all that accounting, the database, they can do that. And so they'll put you into little loans where you're financing just a whole range of companies. But out of your $5,000, maybe your largest loan to these individual companies is in the neighborhood of like $50 or something. So when those companies fail, your exposure is only $50. But because you're in $50 into the one superstar that goes, ballistic, it all works out. And so, anyway, that's the thing, is to spread your risk out, you as the investor, and for you as the wannabe borrower, the lender, or not lender, but the lendee, I guess. Anyway, the borrower, you're on the other side of it, and you might be able to get a better rate than the banks, or you might be able to get any money. If you've got a small business and you think, well, I've got this great idea, I'm going to go to the banks and get a loan. Yeah, good luck. The banks are fairly conservative kind of folks, and like I say, lending's kind of funny. They'll lend you all the money you want when you don't need it, but when you do need it, they're pretty tight-fisted. So I run into this real estate issues all the time. There are no lenders who will lend on raw land. And sometimes it makes some, you can get some good deals on some barren land because everybody in there is a cash buyer. If it's got a foundation on it, then you can get a mortgage for it. Now, I had some property way out by Glacier View, mile 100 or whatever, on the Glen, and I was trying to buy these two little cabins, but they didn't quite qualify as homes because the characteristics of a home, or they were looking for a foundation and a septic system and some other things, that these things were just on the verge. But anyway, when they said nope, they can't be considered a home, that killed the deal because there was no loan options. So anyway, there was one bank that was doing it, but it was 8.5%, 9% interest back when everybody else was doing 3%. So anyway, just not most banks are interested in it. So anyway, it may be, if you're trying to start up something, peer-to-peer lending. But most of the stuff I've been involved in entrepreneur-wise, I really don't like to use borrowed money. I prefer to start small, and if my idea is good, then it should start to pay for itself. If it's not great, there's no demand for it, then I'm glad I didn't have a loan out there. So I like to kind of test the water with smaller projects myself. But, for example, if you're trying to set up a big grow operation or a brewery or something, yeah, you got to have some capital. I guess grow operations, the people do start small. But I mean in a legal sense. I don't mean whatever. So we're not going there. So determine whether the loan's sensible. Yep. Again, if it makes sense. But again, personal loans, they're lumping this thing in there. There's a lot of different things. So real estate and consumer loans are different things. So some of these documents that you had prepared might help you out, or might be used as a reference to compete what the lender actually wants, and then the loan contract. And you're concerned with the interest rate. Right now would be a super challenging time because the interest rates are quite high. So, you see the tech sector and the stock market, they're super hot. Not so much anymore. There's still a few. NVIDIA, that I'm fortunate enough to have some stock in, they've continued. It's just, but that's because of their unique case with AI, and they've always been a unique case, though. I got involved with those guys many years ago, and it's one of the smart things I did was to keep a winner. You're always tempted to hold on to your losers and take your profits from your winners, and that doesn't make as much sense. If you can hold on to a winner now and again, and NVIDIA was one of them. And anyway, every once in a while, a blind squirrel finds a nut, and that's kind of how I stumbled upon that. But anyway, loan repayment schedule, amortization. Amortize, that's just a series of equal payments. So you see this in annuities and amortization. Anyway, just a series of payments. And the maturity is going to be the life, the duration of that loan. So how many payments? Now, this is where when you go to get a car loan or whatever, I find it quite insulting. I do not like to go shopping for new cars. The salesmen, they always want to ask you how much you want for the payments. That's not an educated question. I want to know how much this vehicle is going to cost me, and I may or may not get the financing at the dealer if I'm going to do it. But when you say, "Oh, I want a payment of $350," oh, we can do that, and then you find out you're paying on the car for 10 years or something. It's when I was in Spain, it just got ridiculous. In Spain, they were giving out 60-year mortgages. For most of us, you're not going to be here in 60 years if you're, whatever, above a certain age, and they're giving you a loan that's going to take you out to 100, 110, or it's kind of ridiculous. But it was a way to get the payments lower. And in Spain, they thought, oh, real estate absolutely can't go down. And oh boy, did it. I got out of there in time, but a lot of people got clobbered. Collateral on any loan is a good thing. Collateral is what is the security. That's the thing that's put up. If you're buying a home, your new home is the collateral, and that's the thing that they can take. But that's a good thing because you want them to be secured. When they're giving a secured loan, they're giving it for a better price. If it's unsecured, not backed by collateral, that interest rate is going to be super high. It's going to be like credit card interest because they can't come and just repossess a bunch of stuff. Co-signing, I'm just going to say it, don't do this. There's really no reason. What happens is somebody with not so good credit goes and tries to get a loan, and they say, nope. They said, maybe if you can get a co-signer, maybe if you can get somebody else to sign on the loan with you who will guarantee the loan because your income's not good enough or your track record of paying off debts is not good. Well, what's going to happen, this best friend of yours who comes up to you and says this, you're better off just loaning them the money directly or doing something, but having a couple people on a loan, especially when one of them doesn't have the resources as judged by the business that's refusing it, is a problem. So let's say things don't go well, and this loan is behind on payments and gets sold off to collections, and all of a sudden you start getting letters because you co-signed this loan saying, hey, this loan's in default, you owe us a bunch of money, and your friend may or may not be around. If this thing goes to collections, the collection agency, they're smart. Time is money. They are not going to waste their time chasing the person who originally took out the loan. Granted, they originated the loan, but they also don't have the assets, didn't have the qualifications for that loan. They're going to come after you because you signed on it, so you're legally obligated to pay for it. And so you're probably going to get blindsided. It's probably already going to have some extra charges, and you're in a very weak position. Don't do that, if at all possible. Loan application, we know, it's going to be a little bit more involved than this. It's going to probably be an online application, but whatever. They'll have their own documentations, but they're going to want a bunch of information. But they really want that Social Security so they can access your credit report. We talked about APR before, annual percentage rate. That's the only valid comparative interest rate that you're interested in. Anything else is just kind of fluff. It can be confusing, You want the APR, so that way when they say you're giving you a 3% or an 8%, it's comparable to other APRs that are 3 or 8%. If they use other terms, you don't know what you got. So here's a couple options based upon the interest that they're charging. So interest expenses. Whoops, what did I do here? Sorry. My gosh. Rolling it back. Okay, there we go. So the interest expenses, other finance expenses. Sometimes they'll have some other rate, and then they work in these other. Yeah, the APR takes into account all those different details, so that these other charges are also fit in there and recognized. So you're comparing APR to APR. So all this one looked like it had a lower interest rate at 120. It actually was the most expensive loan because of the extra fees. Repayment schedule 12%. Yep. Not too much. We'll look at a couple examples. But anytime you're paying back a loan, you have the principal and the interest. And it's not so drastic on a short-term loan. You know, this one's only a 1-year loan. On a mortgage, for example, though, you're pretty much just paying interest at first and paying very little principal, the actual amount that pays towards the loan. And then by the end of it, you're paying mainly principal and very little interest. This is actually kind of cool when you're buying a house. You want to pay a lot of interest up front because that's the part that's tax deductible. So a lot of times people, they might even refinance because they say, oh, I'm losing my write-off. Anyway, you have to do the math to see whether that logic works for you. Okay, here they're doing a car loan. How much can you spend? Anyway, you want to, keep it in a need to spend type of thing. Cars, obviously, you want something that you're looking for the lowest ownership rate over time. You don't necessarily want to buy something that's the cheapest if it has zero resale value. I've never been a big fan of EVs because I don't think the electrical infrastructure is there. But I think now, especially with the potential battery issues, the resale of those could be not what you're looking for. Also, maintenance issues, other things. So not only is it the purchase price, but it's the whole ownership equation that goes into it. So I've also found that luxury just doesn't hold value, whereas utility does. Trucks seem to hold. And way back when, I bought a Viper when I was in Europe, and I was buying used, and I was looking at a used Jaguar. It was called an XKR. It's a supercharged Jaguar. It's a pretty fast car and all that stuff. And I was looking at the Dodge Viper, and the XKR, it had everything in terms of leather and wood and everything else. The Viper was just a pure muscle car. It didn't even have windows. It didn't have door locks. It was just pure performance. It had nothing that wasn't functional. And that thing, man, I sold it for quite a bit more than I bought it for, because it was an older one, and it fully depreciated, and now it started to appreciate. Whereas that Jaguar, man, it dropped like a rock. It started out about $20,000 more than the Viper when it was brand new, and it dropped to half the value of the Viper by the time I sold the Viper. So anyway, each to his own. That's kind of a unique thing. Those are not daily drivers, obviously. So just get the car you need, not necessarily the car you want. So price, condition, insurance, resale value. There are things, Kelley Blue Book and Edmunds and all that other stuff, but they're not necessarily accurate in Alaska. Alaska's a non-disclosure state, and then these guys are, I'll go ahead and just call them crooked. These things, Kelley Blue Book and Edmunds, they used to be independent. Well, if you haven't noticed, there's been a bit of consolidation in the car market, with Lithia and some of the other just dealers that are just, I don't know whether you call it a true monopoly, but they're certainly getting close. Anyway, they went ahead, they had the resources, and they've bought up some of these appraisal type companies. So you think you're getting an honest opinion? Yeah, maybe not. Financing rate, loan contracts. Anyway, shop around, and that may include out of state. But even those guys, I mean, there used to be the big dealer down in Kellogg, Idaho. Independent, huge dealer. No, they're I think they're Alithia now. So they get around that. Kelley Blue Book, KBB, yeah. So again, Alaska being a non-disclosure state, being a very small market, and people just not knowing what things are worth. I've sold a number of these two. Sell a lot of tractors, bobcats and stuff, and man, the price people are willing to pay versus what I purchased the thing at an auction, it was fairly dramatic. And anyway, so Alaska's a crazy place when it comes to that. So we have this woman looking again for a vehicle, looking at the maintenance, the insurance. My Viper, unfortunately, I had to drive it with liability only insurance. I could have bought a new Viper every 2 years with the payments they wanted to charge me. Full coverage in Europe was going to be about 20 grand. I'm just like, this is I'll just have to be careful. So I actually got a trip to well, that's a long story, but the Ferrari dealer in Saarbrücken gave me a trip to Moderna, where they make the Ferraris down in Italy, because I was the only person he'd ever met who had a Viper who hadn't crashed it. So I was definitely, I guess, lucky maybe, or cautious in any case. Anyway, expected resale value to the extent you can determine it, but there's certain brands out there, I don't want to show too much favoritism, but yeah, Toyotas and Subarus, things like that. Again, trucks usually do fairly well. Insurance rates, yeah, it can't make a difference. If you're looking at super sporty type things, it's going to get pricey. Repair and service. So I don't claim to be an expert on electric vehicles, but if I was thinking about buying one, I certainly would strive to become one, to figure out what exactly is going on there. Negotiating on the price. So there's a lot of these dealers. Again, I just don't like the tactic. Oh, we're a no-haggle dealership. Well, who's that benefit? I mean, it's not like we're going to increase the price. The haggling is where I get the price, down a little bit. I don't know. I tend to not buy brand new cars, and I tend to buy them usually from private parties and try and find a deal. But anyway, I have the means to fix things when they break, and I've worked on a lot of vehicles and stuff, so I'm not as nervous about it. But if you're in a different situation, yeah, you might have to get a nearly new car. But the problem with brand new cars is you're pretty much guaranteed to be underwater. That is, when you drive it off the lot, it's no longer new. That initial depreciation is just devastating. And so you're underwater for a while. The trade-in tactics, yeah, this is where, somebody's in love with their car and they think it's worth a great deal of money. And so, okay, we're going to give you a great deal of money for your trade-in, but we're going to keep the car at full sticker price. Or they say, oh, we're going to mark down the car, but we're going to give you nothing for the trade-in. I know it's a hassle, but for the most part, you're better off selling your vehicle private party. But again, not for everybody. Purchasing online. So these kind of big Carvana kind of things kind of come and go, but it certainly, would help. I mean, I've shipped a number of vehicles. But again, the vehicle shipping, you can pay anywhere from $1,300 to $4,000. But I've got flatbed trucks shipped from Texas for $1,500, and Subarus for like $1,400, but it's all in the timing and finding the cheapest rates. So again, that's maybe more of a task than some of you are willing to, don't have time for. Financing decisions. Yeah, this is where they stretch out the number of years. Keep in mind, if you're driving this thing hard and your maintenance is starting to creep up, it's one thing to suck it up and have a high car payment when you're driving a brand new car and you don't have much maintenance and, everything's covered. But now when you've got a car that's out of warranty, starting to get miles, and you still have these high payments, so this is the effect of stretching out the thing. So this is when you say, oh, I want to pay $300 as my payment. Oh, okay, we can do that. And all they do is stretch it out, for a longer number of years. Leasing, almost in all cases, it does not make sense. They say in some business situations, I've had a number of business situations, write-offs and stuff, and I've still never found where leasing's a good idea. Leasing is like a long-term rental. You really don't own the car. You're limited on the number of miles you can put on it. The wear and tear has got to be within limits, and there's, just you've got to return it at some point. It is a way, especially with like the BMWs and Mercedes, where they really try to bring people in because it gets them a lower price, but there's not a resale to you, and usually there's some money due back, so you don't build equity. You're still responsible for maintenance, and maybe some additional charges. So student loans, kind of a necessary evil. This is a tough thing. I'm not about trying to screw the government and all, but if they're going to pay them back, I don't know. I don't agree with that, but I don't know. If you're going into an industry, like let's say you're potentially going to be, teaching grammar school out in the bush or something, and that school district that you're going to, has some sort of debt repayment policy or forgiveness, man, I'd be tempted to do it. But go easy with the loans. There's a lot of people who would like to be moving on with their life and, buying a home or whatever, and they're still paying their student loans. So this thing's a mess. I would not expect the whole the teaser things that have been put out there where they're going to pay off these loans. The government's going to take over. It's a popular thing to say during an election, and that's why they say it over and over again. If they ever delivered on it, then the deal would be up. But if they can get kind of a single issue voter who's getting killed by student loans, so they'll vote for the person who promises to take care of student loans. But again, do they? Nah, because they want to use it again next cycle. Home equity loans. This is a source of a loan where if you have equity, so that means some value in the home, you can borrow against it. Now, it's supposed to be for home projects and things, but cash is kind of fungible. Let's say you've got some home maintenance stuff that's going to be done because you're a homeowner, and you happen to buy a new boat with some other money that you had, and it's just so you better show some improvements or some sort of investment in your home if you take a home equity loan, because that's kind of the deal with it, the paperwork you're signing. The other thing about home equity loans is they're tax deductible, because that interest rate's not again, credit card debt, not tax deductible. Home related debt home mortgage debt is tax deductible. One thing they don't talk about in here that I always do, not so much anymore, but take loans against my 401k. Man, can be done over the phone in about 5 minutes. The interest you pay is low, and you pay it to yourself, and you put it back in there. So you're not taking a distribution. You're not touching the funds in the account other than taking a loan against them. And man, it's a great deal. But anyway, and then you pay it off, by your future wages. So it does become a bill, but it's the loan payments are just taken from your pay. So I used it for a number of things, and there's not limitation. I mean, they don't say, it has to be used for this or that. I used it for a lot of business loans because it was way better than the business loans that I would get from a bank or any other venue. Anyway, more about home equity loans. Yep. The home has to be worth more than what you owe on it. So if you've got a $300,000 home and you've got, a $280,000 mortgage, you've got $20,000 to deal with. But if you're underwater, if the market's not doing well, but again, real estate's pretty stable. Generally, you'll have some equity, either by buying it down or by, market appreciation. Home equity loans, yeah, a lot of variable interest rates, up to $100,000 tax deductible. So, payday loans. Now you're into lenders of last resort. This may be the cash title loans, the whatever loans. These are not, these are not where people with money go. So paychecks, financing's outrageous. There's a lot of these things that are just kind of scammy. Like, especially like tax season. Oh, we give you an instant refund. No, you don't. The IRS does not do instant refunds. What they're actually doing there is they're giving you a loan on your return. Fair enough. Loan on your tax refund. But there's going to be some fees involved. So, anyway, the IRS doesn't. Again, I wouldn't advise doing that. Okay, purchasing and financing a home. We'll go into this more in depth at the end of the thing, but we'll kind of do an overview of the important aspects of it. I sold real estate for not too long. I had a real estate license, and I had some friends in it, and I knew a little bit about the business, but it just, if you're going to get into that line of work, you should probably talk to somebody. It's not for everybody, and certainly not for what I was looking for. If you want to get into real estate like that, you got to jump in 100%. There are, probably 3-4% of the people who make 97% of the money in real estate. And then there's all these other licensees out there that are just sort of treading water. And anyway, the way you make money in real estate is referrals and the repeat business and just being a go-getter. And the rest of the folks are just kind of whatever. And it's just not something. The people who are in it are intense. I was being mentored by one of these ladies who's like exceptional. I mean, she's making, I don't know, several $100,000 per year doing real estate. But I mean, I was doing something with my dogs. She said, "Yeah, you need to get rid of the dogs. Those are a waste of time. You need to focus solely." I'm like, wait a minute. The whole work-life balance was 100% not. Anyway, so I'm just like, yeah, this is, sold another home and just called it good and decided I'd rather do other stuff that's more pleasurable. But each to his own. Okay, so buying a home. 10-20% down payment. Yep. Typically 30-year fixed. That's what the United States, that's what we do. These other things, home price 2.5 times your total. Yeah, home prices and incomes, there's such a disparity. So you're probably not going to hit that. Mortgage 28% of your gross monthly income. Again, this doesn't account for different locations, different prices. The best thing to do to figure out what you can afford comfortably is go to a mortgage lender and get pre-qualified. If you want to go look at a house, you're not gonna, you want to go with one of these top agents. You want to go with somebody who's a hard charger, who does this for a living and is going to be on top of it, right? But those people are busy, and they are not going to take somebody. They're not going to waste their time driving somebody around who's not pre-qualified, who doesn't even know what they can afford. So you have a letter after you go and you get pre-qualified and whatever. It's basically a letter from the lender that shows that you've taken the steps and what you're qualified for. And so now you're serious, and now you can go out with one of those agents. Plus, if you find a screaming deal and you have to go out and get approved, that deal's not going to exist. And frankly, if I'm selling a property and you come to me and you haven't been to the bank yet, you're not pre-qualified, I'm not going to take your offer. Or if, say, somebody, say I'm selling a piece of property for whatever, $200,000 and just raw land or something, and somebody's offered me, well, let's make it a house because raw land's not going to sell like that. So, well, let's say loanable a house, $400,000. You're trying to buy the house, and you come to me with a $400,000 offer, and somebody else comes to me with a $390,000 offer, but they're pre-qualified. I'm taking the $390,000 all day. I am not taking that house off the market, signing some contracts with you when you don't know whether you can even buy it. I'm giving up, I'm giving up that $390,000 offer. Plus, I'm giving up the time while I'm waiting on you to figure out whether you're even serious about it. So, yeah, you're at a huge disadvantage, and roughly it costs you about $50, probably $75 now, whatever the credit check costs, and a little bit of your time to get pre-qualified. So do that. Anyway, affordable down payment. So there's a fine line. I mean, you don't want to wait too long. Real estate is appreciating, right? So the longer you're on the sidelines in a renting situation, the more the market is going up. And maybe your amount of down payment, you're not even able to catch up. So, anyway, you'll have more information when you start talking to the lender, because they don't want to loan to people who can't pay it back. There was sort of a feeling prior to 2007, whatever, the big mortgage meltdown, where real estate's a no-lose asset. It never goes down, and mortgage people never flake out on their mortgages. Some rare occurrence. Now, yeah, it recognized that things do go wrong. Don't go for the maximum you can afford. Don't buy above what you can afford. Home values will rise. Values can also drop. Me, I do kind of go big. I mean, it is the one asset where I'm telling you to be cheap and frugal and all that other stuff with buying a vehicle. I tend to go on the other side with real estate, because I want to latch into the biggest asset I can, because it's an appreciating asset, as opposed to a vehicle, which is a depreciating asset. So, but anyway, don't, this is where liquidity, that term, comes up. If you don't have the cash flow to support this, you may be very wealthy on paper with this massive home, but if you are not able to afford everything else in life, you're maybe not in a good position. Single, typically, yep. Price range, cost of renting, cost of buying, certainly. But the thing about renting versus buying, number one, the real estate lobby is very strong. Lots of tax benefits to buying. Renting, all those tax benefits go to the landlord, and then also rent is indexed to inflation. It goes up. When you're buying a 30-year fixed mortgage, that payment, even if they're maybe say it's quite a bit more, $500 a month more than renting, within about 4 or 5 years they're going to be equal, and then the rent's going to outpace it, and then it's not even going to be close as you actually get into it. So, condominium, not a big fan. this kind of comes from real estate experience. Each to his own, but with the condominium, you own everything on the interior. You know, everything from the paint inward. So you don't own the structure. That's all part of the condominium association. The problem I have with condominiums, and my experience is limited to Alaska, but I was involved in a couple of situations where there were people who wanted to sell their condominiums, and the market was kind of soft, and so they said, "Oh, I'll just rent instead." Well, the condominium association, most of the bylaws or whatever their rules, typically say that there can only be so many rental units out of all the condominiums. So you're in a bad situation. You know, let's say you've switched jobs, you're moving out of state, you're going someplace else. You want to rent the condo because you got to go now, and you can't sell it. Well, they may preclude you from renting it. So now you're in a must-sell situation. And I just, that would not occur in a single-family house. They can't tell you can't rent it. Now, again, tenants, oh my God, they can be very good or they can be horrible. I've had both. But anyway, relying on a real estate agent, listen to your input, make your own decision. This is where the quality of the agent is everything. There's some people will tell you about, the drapes and the colors and all this other stuff, and I'm more of I want some valuable financial input. I want to know about the neighborhood. I want to know about the resale. I can fix some stuff. I've always been more focused on the exterior, the environment, where the house is situated, and then the interior within limits, I don't know. But anyway, you got to look at the big picture. Also, especially in Alaska, I looked at a lot of stuff online. This was quite some time ago, but when I was overseas, and man, I found some great deals. Come to find out that one was, in perpetual shady area, the other one was an avalanche zone. There's so many variables in real estate, and I know every place is unique, but I think Alaska is maybe more unique in terms of some of those situations. So, what are the risks? Lower commissions. Yeah, there's the commissions are a very strange thing. They're 6%, but they're not 6%. They can't officially insist upon 6%, but you either pay the 6% or you go somewhere else. And you can go somewhere else, but it may not be what you're looking for. The real estate people I use, they kind of earn their 6%. I mean, I'm paying them 6% to do stuff, not just to. It's not as easy as it seems. Plus, most real estate people, they get in the business, and the good ones, they're confident in their abilities, and they take basically 100% commission. So they'll roll into their office, the first of the month, and they're, I don't know, say $3,500 behind, where they have to pay for their, to their office where they're being, whatever, all those types of expenses, their office space and everything else, MLS fees and the rest of it. And before they've done anything, if they don't sell anything, they've lost, whatever. At the time, it was about $3,600 for that month. But the go-getters, they want to be strictly get 100% of their commissions rather than split them with a broker, and they want to pay that fee up front. The lesser guys will a lot of times do a split. So anyway, criteria to select a home. Location is huge. Taxes, I hate homeowners associations, but they can. I'm sure they have gotten people. I mean, if somebody wants to paint their house, hot pink next to you, it would probably be great to have homeowners association, but personally, I avoid them. But I avoid them by having bigger properties where they don't, I haven't lived in a subdivision, and well, I guess had one in Eagle River, but we didn't have a homeowners association in any case. So Up to you. Resale value, consider the commission. Yep. So when you're looking for a home, yeah, by all means use an agent, because the seller pays the commission. Now you will see for sale by owner, and maybe if they're willing to split that commission with you, that might be some value. But for the most part, the for sale by owner, and again, I'm not in the business anymore, but I would never do the for sale by owner unless it's my neighbor selling the property or something like that. But for the most part, I went out to a whole bunch of things where guys wanted me to list their home, and you walk in there and they think their home is worth, $500,000-600,000, and you're like, that's not that special. This thing's worth about $400,000. They get insulted and they say, I'm going to sell it myself, and so they list it for $500,000. And so you think, it's for sale by owner, it's probably going to be reasonable. No, in many cases, I'll just say that, may have had an agent, and the agent said, I'm not wasting my time. If I list this thing for $500,000, it's not selling. I'm not doing it. And so the person gets frustrated, and they decide to sell themselves, and they want their $500,000. Yeah, it's usually contrary to what you would typically think. Market analysis. These whole things are based on the price per square footage. Again, being somebody who's concerned about the outside, I am not a big fan of these, because what kind of neighborhood is it in? Is it on a 1 acre lot, a 2 acre lot, a 5 acre lot? They're talking about the price of the structure. So it's not that great. And then appraisals. The other thing, even the appraisers know what price was offered. And the appraisers, right now I'm trying to get some raw land appraised, and there's no comparables. What these guys want are comps. They look for similar homes, similar conditions, similar neighborhoods, and then they decide what your property's worth. If somebody's selling 250 acres, those purchases don't happen that often. And the purchase price of something in, South Anchorage versus Meadow Lakes, there's no comparison. And let's say those are the two parcels that have sold. So it's really tough. And so for this particular purchase, it's a complete crapshoot. I'm having the appraisal done, and they're going to pull some number out of wherever, and it'll either kill the deal or enable it. But how they're going to appraise it, good luck. They're not, there's not some sort of technology that's going to enable this for them. So this is how they're using square footage. Again, not useful in my mind. Economic impact. Really, the thing that happens here is interest rates. When interest rates go up, so many people are priced out of the market that the prices tend to go down because there's fewer people in the market. It's all about supply and demand. When interest rates are low, now there's a lot more people who can afford. And so, again, supply and demand, so prices go up. Yep, and that's what they're showing. So I would retitle these as interest rates, because that's how we're defining the economy. Impact of financial crisis. So, yeah, they're talking 2007, 2008. Nothing's really changed. The paperwork got a little worse, but nobody went to jail, certainly. Yeah, they made the forms a lot more difficult. Zoning laws, it's kind of like homeowners associations. Again, it's a two-edged sword. You don't necessarily want somebody putting a junkyard in next door, but again, you don't want somebody, telling you how many trees have to be in your front yard. Negotiating a price. Yep. This is where a good agent will help you. It's like buying anything. I bought a sawmill this weekend, and it's whatever. you don't want to pay the full price, but you don't want to insult the person by offering too low a price, and then they whatever. You want to figure out kind of what the lowest price. I'll tell you how not to do it. I was buying a Porsche from a guy in Europe, in Spain one time, and it wasn't much of a Porsche. It was a little 924. Anyway, I'm trying to buy this Porsche, and the guy, I don't know what he wanted, like $2,000 or something. It wasn't much of a car. And I said, well, what's the lowest you'll take? He goes, I'll take $1,500. I'm going, okay, I'll do it for $1,500. He's like, no, I don't want $1,500. $1,500 is the lowest I'll go. I really want $2,000. I'm like, well, okay, you clearly haven't done this before. You're getting $1,500. But no, that's not what I'm like, okay, then this thing's not going to work. Well, okay, I'll take the $1,500. Whatever. Don't be that guy. Transaction costs. So down payment, some collateral, yep. Depending on your loan situation, again, good info that you're going to get from your real estate broker, mortgage broker. PMI is a pain in the butt, but sometimes you'll have to pay it. I did it one time. I was buying a home in Las Vegas, and the real estate market was just zooming. And so it was one of these situations. It's like, not going to wait to get the full down payment. I'm just going to secure it right now. I'll take the PMI, and it was painful. It was a couple $100, onto the mortgage. But literally, about 3 months into it, I paid $400 or $500. Had the house reappraised. It gone up by $20,000. Bada bing! I had the 20%, equity now, and the PMI went away. So, in certain cases, it can be done. All these different fees. Yep. Loan application fees. But typically, all this stuff adds up to about $10,000. Typically, it seems like about the amount of money. Sometimes buying a loan down, they'll do that. Loan originations fees, whatever. They're all fees. There's a certain order. Some are paid by the seller and some are paid by the buyer. But again, your agent will help you with that. Fixed mortgage rates, you can get a variable, but these are, I don't know that I'd want to jump into a fixed one right now. I probably still would do a fixed. If you get a fixed mortgage, it's going to stay that unless you refinance. If you get a variable, it's going to change based upon the prevailing interest rates, but only a certain amount and only over a certain period of time. Now, if interest rates are low, let's say down around below 3% again, oh boy, you want to get a fixed. You want to lock that in. Amortization schedule. This is how the payments are done. We'll look at one of these. It's the amount of principal and interest that's paid. So here, this is what I'm talking about, where it's fairly dramatic. 360 months is a 30-year mortgage, right? So here, this payment, this is per 100,000 at a 5% rate. So, you're buying a $300,000 home. You just triple these numbers, so 1,500-ish. So anyway, per 100,000, it's $537 is the payment. Stays the same month 1 to month 360. But see how the principal and interest changes? At first, very little principal, but a whole bunch of interest. By the end of it, pretty much all principal, very little interest. And that's just the nature of the way loans are done over time. So the principal there's nothing to be done with it, but the interest is tax deductible. Here, your tax deductible is a whopping $3. Impact of the mortgage amount. Yep, impact of the interest rate. We'll take a look at that. So, another illustration of that principal and interest. So here you got $5,000 tax write-off. Here you got 171 bucks. If that wasn't clear, yet again. So, I mean, literally, when I was growing up, my parents, their mortgage, because it was a 30-year mortgage, their mortgage payment was $133. I mean, it was laughable then. That's a complete joke now. But, you know, $1,500 mortgage right now, 30 years from now, you'll be laughing. You know, you won't even be able to, hopefully they won't even be making Big Macs then, but if they still are, you know, you'll probably be able to get one for $1,500. So tabular data is all right, but we'll look at some actual examples. Estimating. You don't have to estimate. We can actually go on there and take a look. Bankrate.com is one option. I use Bankrate to maybe check and see what the prevailing rates are, but simple Google stuff will help you out with that. But this is where people get priced out of the market. You know, let's say per 100,000, if it's only 4%, 477. If the rates are what they are now, 734. I mean, that makes a huge difference. You can also get 15-year mortgages. Me, I always prefer to get the 30s. If you want to make more payments, you can. If you don't, then you just suck it, you know, go back to your 30-year thing. You can pay off a 30-year mortgage in 15 years just by making extra payments. So I like the flexibility of the 30-year. Characteristics. So again, you know, some of these people that are just, loans, all debt, all loans are evil. You know, that's their opinion, and they want to pay them off as quick as possible. Me, not so much. ARMs, adjustable rate mortgages. I've had these before. They're very big in Europe, and they're typically lower. You know, if you're somebody who can't afford the house, not a great strategy, but you can probably afford it if you're using an ARM, because for a bank to commit 30 years out, you know, a 30-year fixed mortgage, they're taking quite a bit of forecasting, quite a bit of risk in making a commitment 30 years out. If they're just doing an adjustable rate, they're not risking as much. So at the time, I think when I took the loan on, I think the German house and and my Spanish house, I think they were both, maybe prevailing interest rates are about 5%, and the adjustables were about 3%, and I had adjustables on 3%. The Spanish house, I only had it 3 years, and it was like I say, the real estate market there was booming. It was going up by, what was it, 19% per year. I had the house 3 years. I got the purchase price that I paid for it, and I just did 19 times 3, which is, you know, just short of 60%. Multiplied that by the house, listed it, and sold it in 4 days. I was, you know, when it's good, it's good. A year later, that same house was underwater. So I knew it wouldn't last, and the nature of Spain was what it was. So anyway, you have to be kind of cognizant and know when's a good time and when's not. Anyway, yeah, there's advantages to both. You have to look at the time. You have to talk to it really. You know, I'm on first name basis with the mortgage guy, and you know, I get the Christmas cards. He gets commissions from me and all that stuff. Everything's fine. He does make some money from me, but you know, I get good service from him, and I don't mind paying for it. So anyway, caps on adjustable rate mortgages. So just because you have an adjustable rate mortgage doesn't mean it can go to the moon. There are going to be limits. You know, it might be able to go up maybe, say, 1% per year. So it's not like you're going to be, you know, and it's going to be tied to an index. In Europe, it was always the LIBOR, the London Interbank Exchange Rate. In states, it's prime plus 1 or something like that. Anyway, they pick a published rate, and they have an index with it, and it just goes up a certain percentage. But within a couple 3 to 5 years, yeah, you can get in serious trouble. But you could also refinance at that point. Home versus rent. So for some of us, I mean, it's not arguable. I've always had pets, animals, stuff like that. Not ideal in a renting situation. And I don't like, dense environments and neighbors and the rest of that. So I'm not a renter. But owning, there are sometimes more costs. You're certainly tying up a down payment. The closing costs, yeah, they're kind of lost. Maintenance, a portion of your rent is taking care of maintenance, but your own home, taxes, anyway, all this stuff is still going to be paid. You just have to look at it. But the tax advantages, building equity, really wealth building is most people generate wealth through real estate and building equity. So yeah, some of these more creative loan schemes kind of went away after 2007 or been phased out. They had some like interest only loans. They had balloon payments where they'd be very small, but lenders are a little less. They're more risk averse than what they used to be. So you don't see so many of these type of programs. Yeah, interest only. But essentially, almost any mortgage is kind of interest only. You saw the portion of interest that's being paid versus principal. Doesn't make a huge difference. Refinancing. Typically, the rule of thumb was 1%. If you have a house that's financed at 4% and rates drop to 3%, or you have a house at 7%, rates drop to 6%. But this again is the time to have that relationship with that local guy. So again, I don't know. I mean, I guess if I called whatever Rocket Mortgage or Quicken or whoever, they'd probably give me some advice. But being able to call my buddy and saying, hey, I'm thinking about refinancing, does it make sense? And they know what the costs are, because there's going to be some loan origination stuff that's going to change. And anyway, but generally interest rates have to go down by about a full percent before it makes sense. Okay, so let's look at one thing on here. So I didn't assign any homework for this week, which is all right. So here's something. This is kind of interesting. And this is, I mean, all you do is type in mortgage calculator. Google itself comes up with something. Even if you spell mortgage wrong. Okay, I left a T out. Okay, so here, let's concentrate on this part. Loan amount, $240,000. So let's make it more relevant. I mean, I think most homes are probably in the neighborhood of $400,000 now, right? Okay, so $400,000 itself. It populated this rate based upon the prevailing rates. So, earlier when I was looking at this thing, it was actually not 800%. That would be kind of bad. 8%, whatever. So the other one was 7.9. 30-year fixed. So this is why there's not so many people looking for homes right now. If the interest rates are 8% or even 7.9, I'll put it back to what they had it. They actually pulled a rate from bank rate. In fact, let's check bank rate and see what they got. The problem with these guys is, it's free service, so there's going to be a lot of different ads. Today's mortgage rates. Best savings accounts. Home purchase. But they're going to want to try and direct me into something. Okay, fine. So, yeah. Let's just try this. Today's mortgage rates. Yeah, so initially they want to go and get me directed to where I'm going to start having to put in my email address. I'm not going there. Okay, so about $3,000 a month is what this is going to happen. Now, this is without taxes and fees and, say, insurance. So if you hit that button, all of a sudden now, you know, it's going to ask you what your credit score is, because that's going to figure out perhaps your interest rate might change. Property tax, $6,200. Home insurance, $1,750. So you can see your payment went from a little bit, you know, $2,900 up to $3,600. Yikes! You know, that's a higher number. Obviously, it's your lesson of the day. Okay, so let's say, you know, we're 3 years ago, 2.85. Yeah, all of a sudden things are quite a bit less. How did we get to 500,000? Did I do that? So 2.85 is going to be 23.21, and if I go 7.9, yeah, 35.74. So you can see, you know, the difference in the crowd when they go to their mortgage broker to get you know, approved. There's going to be a lot of people who are just excluded as those interest rates go up. And so there's a smaller pool of people who can buy that $400,000 home. So when you want to get top dollar for your home, you know, in a 7.9 interest rate market, there's fewer buyers, you know, supply and demand, fewer people willing to offer that kind of money. So it hurts everybody. Homeowners Association, PMI, you might have to pay. There's other fees in here that will sometimes, you know, and this was just off of Yahoo right now. What are they saying? Yeah, see, now they're this is what I've seen before, 8%. Let's look at this credit score thing. Now, I'm using what do you call it, a VPN, so they keep thinking I'm in Seattle. Anyway, 20% down, 700 score. They're showing I'm going to get 7.9. Let's say my credit score is not quite as good. Let's put it right at 600. Data not available. BZ, give me a load. Let's go with 680. Yeah, so a couple points more. So, you know, credit scores are important, but, you know, especially when you're about to buy the home. 7.4. Now, how is it going to get to 800 up? 7.3. So, you know, they're changing the rate a little bit on you. Let's say you're trying to get in early, represent a little bit more risk. Probably gonna have to pay a PMI. Anyway, there's lots of data out there, but really the first step is to pick generally a local mortgage banker and go to them, talk to them about what you want to do, and have them, you know, give you the letter so you can actually go out and start looking for the property and be serious about it. The thing with loans is the people locally, they take care of all that paperwork and then they sell off the loan. So, you know, whatever. Wells Fargo, Freedom, there's different big nationwide lenders who buy up the loan. It's transparent to you. The payment amounts don't change, but where you send your payments to do, but you have no control over it. You signed up for it. Again, it doesn't affect things, but having the local presence to help you get the loan, I found that to be invaluable. Anyway, hope you learned something, and we'll talk more later.